What's up, guys? Today I want to talk about why I believe it is not beneficial to be a long-term investor so just for background, I've been investing since I was 17. Right now I'm 26, and so it's been about 9 years of investing, and I've done tons of different types of strategies. I've watched lots of YouTube videos, read lots of books, lots of stuff. I took college courses on this when I went to Purdue, lots of stuff, and I've been, I've got lots of experience from trading, day trading type style all the way to, Warren Buffett type style where he says hold for 30 years and all that. And that's how I used to think. I think there's, obviously you can benefit from that. You're going to make money if you sit on a stock for 20, or let's say the index, at least the whole market for 20 or 30 years. But there's just stuff that I've come to learn and realize and figured out market cycles, market sentiment, and then market valuations and the way they tie into each other to where I know people say you're not supposed to time the market, and I don't want to say that's exactly what I'm doing. It's not like I'm calling the top and the bottom, but you have the way to make it so much more profitable and make a lot more sense is you have an idea. When the market is really hot and we're on a long bull run, the stats show, okay, every 2 years on average, we have a 10% drop. Every 7 years or so, we have a 30% drop, right? And you can look at these trends and these changes to kind of say, okay, now I'm going to sell some shares here. And this works. I mean, it's a great, the index fund the whole market is a great example to use that strategy. But I was looking at a stock yesterday, Airbnb. That stock went IPO, I think, like 5 years ago. Okay. And it's pretty much at the same price it was like 4 or 5 years ago. But you could have made lots of money in between those times, which I did. I've traded that stock several times the last 4 or 5 years. First of all, I don't buy IPO, so I would never buy it at, those sky high valuations. But it just makes, even if it's not an IPO, it still makes sense to me to say, okay, if the stock's at $100 and it gets all hyped up and people push it to $300, okay, that's probably not the right time to buy. A good example of this is Coinbase. Go look at I remember the IPO of Coinbase was like that. It did something crazy like that. It was like starting out at $100 and went to like 350, 400 because, crypto was the hottest thing at the time. And, look what happened with that. It comes crashing down. Same thing with Airbnb. It went to, I don't know, I think it went from $100 to $200 or something like that. And really for me, the last 4 or 5 years, the buying time for that stock was when it was like, I don't know, maybe 110 and under, something like that. And most of the time what happens with those companies that are, well-known, popular brands like that is you get it, you get it 50% off. It cuts in half or something, right? It has a bearish, after it has a hype cycle for a couple months, up to a year maybe. Then it comes crashing down. Then, you get it, 50% off, something like that, which I did. I bought in, I don't know, I'd have to go back and check. It's probably been, I've traded the stock multiple times over the last couple of years. But let's say I bought it at 90, 100, and 110, something like that. Most of the time what happens is the stock will go up 30% or so over the next following, 6 months, let's say. And that's your chance to take some profit. So my argument, I guess you could say, is I just think it does not pay to be a long-term investor, with the way that Warren Buffett describes it, where, buy the stock and hold it for 30 years and don't look at it. That doesn't make a whole lot of sense. The stock market does not reward you for that stuff. Again, you will make lots of money if you sit on the S&P for 30 years, but that's not the point. The point is, it's like the market goes and you pay attention to the stats a little bit. You follow the swings and the sentiment and the valuation a little bit, and you realize, okay, if the market averages 10% a year and I made 40% this year, okay, well, it's probably, let's say we haven't had a crash in 5 years. Okay, I bet I probably should take some profits. If the S&P PE ratio is way higher than what it's been the last 5 years, and there's obviously a bubble, there's a bunch of retail speculation, all this stuff, you should not be buying stocks at these high valuations that make no sense. You just look at historical data. You say, okay, normally this thing trades at 20 times earnings. Why am I going to pay? I'm not going to go all in when it's 30 times earnings or something like that. That just doesn't make sense. So it just, to me, it pays off. I see too many examples where, like Airbnb is a good example, but then you look at Meta, you look at AMD, you look at all these companies where they go through swings, right? And so you just have to buy it at the right time, which, like, what just happened when Trump put these tariffs on in April? Was that February or the last couple months? Whatever happened the last couple months, we had, I think the NASDAQ went down 26%. I had kind of seen that coming. At least before that, I realized that, okay, now I had said this months, so I was waiting months for this to happen. But, I realized, okay, I'm going to stack up on cash and sell a lot of my stocks because I can't wait till the market comes tumbling down so I can put all my money in. And right now, most of my money went into the NASDAQ, but I also bought, another 15 stocks or so that were just big names, mostly ones that I, wanted: NVIDIA, AMD, Texas Roadhouse, whatever. I got Google, Amazon, Meta, all that stuff. So I guess like the main strategy here is just to, you take some profits when the market is really hot, but it just does not make sense to sit on it for a long period of time, 10, 20, 30 years doesn't make sense. You need to kind of trade according to those market cycles where it's like, okay, every 2 years, we're going to have a 10% crash. So I'm kind of waiting for that. Like, I'm going to try to ride out my gains for, maybe 6 months, 12 months, maybe. Obviously, when you get past a year, it's beneficial because of the tax benefit. You get lower tax rates. But still, I'm not going to wait another 6 months. Like I just sold a bunch of ELF stock, and there's other ones, ELF and Taiwan Semiconductor, because ELF I just made 80-90% on in the matter of, I just bought the stock like 2 months ago, right? Because I bought it at the right time. The ELF stock was over $200 a couple months ago, and then in this crash from Trump, it went all the way down to $50 or something. So I'm like, okay, let me buy some ELF stock. I bought some ELF stock, and now it's 130, right? I think my average cost was 70 or something like that. But the point is, you buy at those times when the market crashes. I'm following the stats. I'm following the historical data here of, okay, the market crashes, and every 2 years it crashes, let's say 10%. And, I think that's for the S&P. In this case, the NASDAQ dropped 26%. So it was pretty close to a real, full-on market crash rather than a correction. But the point is, I waited I realized we haven't had something in 2 years because we had a big one in 2022. I'm like, okay, 2024 is probably going to be small to mediocre. It was a little bit bigger than I was expecting, but still not that bad. I ended up, I remember I stacked up on cash, so I had a bunch of money ready to go. And I also, this time I was so confident because I knew these trends that I borrowed on margin for the first time. And I borrowed $15,000 at a 5% interest rate for the whole year. I only used it for 2 months. Well, maybe a little bit, 2 to 3 months. I used that $15K, and I made 10%. I made 10% on my index, on my investment in the index, and I only paid what, maybe 1% or less, really less than 1%. I paid around 1% in interest, and I made like 10%. So just because I knew the data and I knew the way the trends work. So I guess that's how you have to look at it. I guess if you invest in an index fund for 20 or 30 years, I just look at that like you're losing out so much. And that's how that's how you can, lose money, is when you're buying at the top, right? And then so many people, so many of my friends and family members, they sell when the market crashes just because, part of it is that, financial advisors recommend, or they tell their clients to sell, right? But even if they don't have financial advisors, there's still people that I know that they sell when the market crashes, and they're losing a fourth or a third of their money in their 401k or whatever it is, and it just doesn't make any sense. So I guess that's my main point here, is just that, you look at what the market does for, I don't know, over the long term, let's say 10 years, 20 years, something like that. And then you realize if you would have just made some, common sense, simple trades there where you took some profits when when the market was really hot, and you knew, a crash was by the stats, the market crash was bound to come sometime soon. Same thing, when the market dips, we just had a 26% dip in like a month or two. Instead of selling like everybody does and they lose all their money, locking in those losses, you buy, right? I literally put all my money, I literally had all my money saved up, a lot of money saved up. Then on top of that, I borrowed another $15,000 to put on top of that, because that's how confident I was when those because I knew that was such a golden opportunity to invest, right? Because that's when you make a lot of money. Like I said, the index is up. I'm 3 times. I'm outperforming the NASDAQ right now by 3 times. The NASDAQ is up 11% over the past year. I'm up 29% or something like that. The numbers are like 10 to 30%. So, I mean, it's just, you just have to play the market smart like that. You don't sell when stocks go down 25%. You buy, right? And then when the market goes up big, let's say for like multiple, when the market goes up for multiple years, that's when you sell. You take not all of it, you don't have to sell all of it, because yeah, you could go on a 9-year bull run like we did, in the previous decade. But what's more likely to happen is you're going to have a crash every couple of years. Again, every 2 to 3 years, you have a little, not a crash, a correction. And then every 7 or 8 years, you have a big 30, 40% crash. And so just realize those numbers, because you can make a fortune. Like, it's not hard to make 30, 40, even more, 30, 40, 50% even in the index fund in 1 year, right? Because I just made 10%. I mean, the market the QQQ just went from $400 to $535 within a matter of a couple months. Okay. That's like, if you got 400, if you had 400 grand in there back in April, you'd have 530 grand right now, just a couple months later. Okay. So, compare that to the people who, what the safe thing to do is to, sell your stocks, sell the stocks in your retirement account when the market's down 25%. So you just locked in a 25% loss of your wealth, when you could have did what I did, put all your money in, everything you got, plus borrowed on top of it. I'm not saying borrowing is always a good idea. That was my first time doing it. But in this case, I wouldn't do that with any stock. I wouldn't do that with like an individual company, really. I really only wanted to do that with the index, because I knew it was going to come back and it was one of the safest things out there. So that's the end of my story here. It makes more sense. It does not make sense to hold for 20 years. I really think you're leaving a lot on the table, and I think you're losing a lot by just holding for 20 years, because there's too much. The market doesn't reward you for that. The market rewards you for, hey, okay, everyone else is being greedy. Let's be fearful now. Let's start taking a little bit of profit. Doesn't have to be all of it, depending on how confident you are, how risky you want to be. Sell some profits. If you don't want to sell everything you got, that's understandable. That's kind of extreme. And then on the other hand, again, when the market drops, you buy in. And I would just say you follow the trends. 76% of the time, the stock market goes up. Every 2 years or so, we have a 10% correction. Every 7 years or so, we have a 30% crash. So those stats like that, those are the guidelines for what you should follow. That makes the most amount of sense. And that's how you make the most amount of money. That's how I just made, whatever, I'm up 30% in the last year. The index is up 10%, right? And there's plenty of years when it goes up 40% from the bottom, because just in the index fund, that's not even mentioning if you buy individual companies. I mean, I just made 90% on Elf stock in 2 months, because that was one of those, high flyer stocks. But even, you could do it with Meta. Meta has been insane the last couple of years. I was buying Meta. I bought Meta shares at $150 a share more than once over the last 6 years. Today, Meta is $700, right? There were so many chances to make money with that stock. And that's one of the biggest companies in the world. It's not like it has to be penny stocks or, even small cap companies. So, I mean, you put the money in the index, plus, let's say you split it up between Amazon, Netflix, Costco, and a Meta or something like that. Okay, well, I mean, that's why I outperformed so much, was because I put majority of my money in the index, added on 15 stocks of ones that I really liked. I wasn't going to buy junk like Verizon, Walgreens, and I don't know, what's another junk stock? I don't know, stuff like that or AT&T, ones that aren't really profitable. They got bad balance sheets and all that. No, I bought the ones I knew were going to be important companies, specifically semiconductor stocks I've been bullish on for a while. I bought a bunch. I bought AMD, Nvidia, Taiwan Semiconductor. I think I bought another one I forgot. And then the tech stocks, the companies that rule the world, the Meta, Google, Apple, Amazon, you can put Netflix in there, those type of companies. And, I have my own personal favorites that I was kind of just, interested in getting. Texas Roadhouse is one of those. Elf was one of those. Those are ones where, that's not for everybody, but those are just ones I was confident in that I wanted to own. But that's my main argument here, is just rethink your strategy and rethink the reputation that long-term investing has. And how does that, does it really reward you, or are you does it make more sense to do what I'm talking about and being more of a swing trader where I'm going to hold some of these stocks for 3 months or 6 months and then sell them because I just made whatever, 30%, 50%, something like that. And, I might do it again. I might make 50% in 6 months and then put it in something else, make another 50%. So yeah, I'm paying more in taxes, but I doubled my money instead of making 50%. And it's just stuff like that. So that's the end of my argument here. Give me some feedback in the comments, and I will talk to you guys soon.